Welcome to another session on series of financial managements, and today we are going to discuss about capital structure. I, Dr. Neha Seth, working in the capacity of Associate Professor with Indira Gandhi National Open University, and today we are going to elaborate this particular topic under series of lectures on financial management, that is capital structure. The word itself, the term itself includes two words, that is capital and structure. In previous classes, in previous lectures, we have discussed that what is capital, what do we mean by this particular term called capital. So, capital is basically fund that is required to start the business. Whereas another term or another word in this particular term, that is structure. Structure means architect or maybe a particular arrangement. It is a way some things are put together to form something else. So, these two terms combine together to form capital structure of the company. That means how we are going to organize the capital in a company so as to get best results out of it. So, when I say the word best results, I mean when a company is trying to improve the profit and at the same time they want to reduce the cost of capital. Okay. We have already discussed this concept of cost of capital in our previous lectures. So, now we will continue with this particular topic, that is capital structure. So, basically a company requires capital, any company requires capital for its smooth functioning. And here in financial management, we have two major sources from where we can gather the capital. One is from shares, which is popularly known as equity. Those shares can be equity share capital or preference share capital. But word equity is a commonly used term in financial management. So, one source of capital can be equity and another source of capital is from debentures or which is popularly known as debt. So, there are two major sources of capital that we have in financial management. One is equity, another is debt. So, most of our discussion will revolve around these two types of sources from where we can gather the capital. Now, when we proceed further and we are discussing about capital structure, so there are certain factors that impacts the capital structure of the company. These factors may be internal, these factors may be external to the company. Let us see these factors one by one. So, when I say internal factors, so these are the factors which are internal to the company or which are specific to a particular company. And up to a certain extent, these factors are controllable or we can change as per our requirement. Though capital structure decisions falls under long-term decisions, that this is also something we have discussed in our previous sessions, that these are long-term decisions that a company needs to take, and once these decisions are taken, it cannot be reversed. Or if these decisions need to be reversed, it may take huge amount or a company may suffer lot of losses, huge losses if these kind of decision needs to be reversed. So, we need to be very careful when we are taking the decisions related to capital structure as well. So, we will be discussing internal factors that impacts the capital structure of the company. So, the first internal factor may be size of the business. Okay. Now, it depends upon the size of the business. According to, if your business is very large, you may decide from which source you want to get capital, whether debt or equity. If the size of business is very small, maybe a small amount of debt may serve your purpose or a short term debt may serve your purpose. This short term debt may bring in capital for you and you can utilize this capital, and once your requirement is fulfilled, you can easily return this capital, and this capital, this debt is available at a nominal cost which is known as interest that we are paying. Similarly, the regularity and certainty of income depends upon regularity and certainty impacts the capital structure. Regularity and certainty of income. If your income is certain and regular, then you can definitely opt for debt, because there is a fixed charge that we need to pay when we are raising funds through debt. Okay, we need to pay interest whether we are earning or not, we need to pay the interest. So, we need to be careful when we are opting funds from any particular source of capital. So, we need to be very careful. If our income is regular, income is certain, then only we should go for debt. Then age of the firm. So, as the firm is growing older, okay, it is getting popularity, people are knowing it, and when this firm is getting older, there are people, there are investors who would like to come and invest in the company in the form of sharing equity. But when the firm is new, okay, there are hardly any people who want to come and invest in the equity. So, in that case, the owner may go for debt as a source of capital. Then desire to retain control. Sometimes as a owner, I don't want to dilute my control. So, I don't want to give share to anybody and come and invest in equity. In that case also, I would prefer debt as source of capital instead of equity. Then what are my future plans? What are my strategies? According to that, I may plan my capital structure. What will be the proportion of debt and equity in my capital structure? Then operating ratio. Operating ratio may not directly impact the capital structure, but operating ratio tells us the efficiency of the company, the operating efficiency of the company. So, accordingly we may decide from where we can raise our funds. Then trading on equity. This is also known as financial leverage. We will discuss about this in future classes or future lectures in detail. But in short, when we are trading on equity also impacts the capital structure, because the ultimate aim of raising funds or inviting shareholders is to give back to our shareholders in the form of increasing their wealth. Okay, this is one of the objective of financial management. So, when we are keeping this in our mind, we may decide upon our capital structure based on this factor as well. And then we have period of financing, for how long we want to raise the fund. If we need funds for very short term, then of course debt is the easiest way through which we can raise the funds. But we want to get the money for longer duration, then it would be better if we go for with equity. So, these are the internal factors which impacts the capital structure of the company. Then there are certain external factors as well which impacts the capital structure. So, when I say external factors, the first one includes capital market conditions. So, what is the situation of the capital market of a country? It is one of the most important factor, and this is something beyond our control. We are not able to control the situation of the market. Okay. So, whatever the situation or condition of the market, it is going to impact our capital structure as well. We need to readjust the proportion in which we are using debt or equity. It may also be possible depending upon the capital market condition of a particular country. Then the kind of investors, the nature of investors we are having with us. So, there might be people who are very positive, okay, for our company, and they would come in front and would like to invest in our company. But at the same time, there might be investors who are not very keen or maybe very interested in investing in our company. So, depending upon the nature of investor, this is again something beyond our control. So, what we can do, we may look for more investors. We may pitch our ideas to this investor and we may invite them to come and invest in our company. Then there are certain statutory requirements, some legal requirements we need to fulfill. Okay. For example, in case of banks, banks cannot raise funds from external sources other than by issuing shares. Okay. So, this is something they cannot do. Banks cannot get the money except for getting the money through shares. So, these are certain policies or legal requirement or policy infrastructure which is there in our country, which a company cannot go beyond when it comes to raising funds from different sources. Then taxation policy, how the taxation policy of a country is. It also, like in case we are raising the funds through debt, we are getting the advantage in the taxation of our company, the tax that we need to pay. Okay, so this is how we may decide that if the taxation policy is favorable, then we may go and opt for the debt as source of finance. Then we have cost of financing. So, what cost? This is again most important thing. Okay, what is the market value of a particular source of finance? At what rate, at what amount we can raise funds through equity or debt? This is something most important. In previous lectures we have discussed about cost of capital. So, what cost we need to pay when we are raising funds from different sources also impacts what will be the capital structure of our company. So, these are some external factors that impact the capital structure of our company. Now, coming to this term called optimal capital structure. So, what is an optimal capital structure? Optimal means something which is perfect. But it may also be possible that what is perfect for me may not be perfect for you. So, what is optimal for me may not be optimal for you. For me, it may be possible that 50% debt or 50% equity is good enough for my company. But it may also be possible for you that you want funds in the form of debt as 40% in 40% ratio, while from equity in 60% ratio. There is some third person or third company who wants this ratio to be 25 or 75. So, there is no specific optimal capital structure, but it depends upon the factors that we have just now discussed. It depends upon our requirement, that what is the optimal capital structure for me. So, it is nothing but the most economical and safe ratio between different type of securities from where we are raising the funds. So, optimal capital structure may also be defined as a mix of debt and equity, which maximizes the value of the company and minimizes cost of capital. So, when we are discussing capital structure, or when we are fixing, or when we are trying to define the optimal capital structure, so a perfect capital structure can be that capital structure which may be helpful in increasing or maximizing the value of the company for us. At the same time, it is helping us in minimizing the cost of capital that we need to pay for raising the funds from different sources. So, wheresoever we will get this combination is the perfect capital structure for anybody. Then there are certain qualities, essentials of a sound or an optimal capital structure. There are certain points we need to keep in mind when we are finalizing our capital structure. First one in this may be minimum cost of capital. So, optimal capital structure I just now mentioned is the one in which we can make a combination, we may have that combination in such a way where our cost of capital, the amount that we need to pay to raise the fund, is minimum. At the same time, the risk we are exposed to is also minimum. Also, a capital structure which is optimal will give us the maximum return. The return will be maximum and the control will be maximum. So, we as owner may be holding maximum control, is the one which is also known as optimal capital structure. And then flexibility. It may be difficult to change the capital structure, it may not be easy, but at least we should not be very rigid in changing the capital structure, because the market condition and there are other factors that we have discussed keeps impacting the capital structure. So, any capital structure which is flexible enough, which will give us option to change this ratio of debt and equity in our capital structure, is the one which can be defined as an optimal capital structure. And of course, is the most important one, which is fulfilling the legal requirements. If we are fulfilling all the 5 points in an essential as a sound capital structure, but we are overruling the legal requirements, then all these 5 points are useless. So, again, this is one of the most important point, that we need to fulfill the legal requirements whenever we are designing our capital structure. So, these are the points where which makes a capital structure the optimal one. Moving to the new term, call it valuation of firm. This was the term which is introduced in this particular topic, because when we are talking about capital structure, we are also concerned about increasing the value of the firm and reducing the cost of capital. So, the valuation of firm depends upon the earnings of the firm. Okay. If the earnings are good, the valuation of firm will automatically increase, but at the same time the cost of capital, cost of raising funds should also be reduced. So, the valuation of firm depends upon the earnings of the firm, and the earnings of the firm further depends upon the investment decisions. The earning of the firm are capitalized at the rate equal to overall cost of capital. We can also call it KO, or weighted average cost of capital. Now, this is done in order to find out the value of the firm. So, the value of the firm may be equal to EBIT, that is earnings before interest and tax, divided by overall cost of capital. So, the value of the firm depends upon two basic things, earnings of the firm and overall cost of capital. If these two things or two factors are combined together, we can easily calculate value of the firm. Okay, this is the base of capital structure. This was the theory of the capital structure. Okay, now moving ahead to the practical part of the capital structure. Now, when we are talking about capital structure, there are certain theories which are given by famous people in past about capital structure. There are four theories that we have under capital structure now, that is net income theory. We also call it NI approach. Net operating income theory, this is also known as NOI approach. Then we have traditional theory, and we have Modigliani-Miller theory, or we also call it MM approach. Now, there are two things which also came into the mind while these theories were designed, that there are theories which says that capital structure, we call it relevance theories of capital structure, which says that capital structure impacts the valuation of the firm. Capital structure is relevant when it comes to valuation of the firm. So, here two theories out of these four, that is net income theory and traditional theory. These are relevant theories of capital structure or relevance theories of capital structure, which says that the combination of capital structure, the ratio of capital structure impacts the value of the firm. On the other hand, it is also mentioned that capital structure is irrelevant when it comes to valuation of the firm. So, whatever your capital structure is, whatever ratio you are having of equity or debt in your capital structure, it is not going to impact the valuation of the firm. So, remaining two theories that is net operating income theory and Modigliani-Miller theory says so, that capital structure is not going to impact the valuation of the firm. Now, let us discuss these theories one by one in detail. The first one is net income theory. Okay. According to this theory, a firm can increase the value of the firm and reduce the overall cost of capital. So, these are the two primary things that we need to do when we are discussing capital structure, that is increasing the value of the firm and reducing the overall cost of capital. And this theory says that it is possible. It is possible by increasing the proportion of debt in its capital structure to the maximum possible extent. So, this is what this theory defines. So, if we are changing the proportion of debt in our capital structure, that means if we are increasing the proportion of debt in our capital structure, it is possible to reduce the cost of capital and at the same time to increase the value of the firm. Okay. Like any theory is based on certain assumptions, this theory also based on certain assumptions. So, the assumptions of these theories are cost of debt is cheaper than cost of equity. This is something we have discussed in past lectures as well, that debt is generally considered as cheaper source of finance. So, this is something which is kept as assumption for this theory as well, that cost of raising debt is cheaper as compared to cost of equity. Income tax is ignored in this theory, and cost of debt and cost of equity, that is KD and KE, will remain constant. The total requirement of the firm are given and constant. So, the requirement of firm is also not going to change in long term. So, based on these assumptions, the theory is defined in the form of this equation, where value of firm, that is V, is equal to E plus D, where E stands for market value of shares, or we may also call it equity, and D stands for market value of debt. We may also call it debentures. And in past, we have, in the previous slides only, we have seen that valuation of firm can also be calculated by dividing EBIT by KO. EBIT is earning before interest and tax, and KO is our cost of overall cost of capital. Okay, this is, so valuation of firm is equal to equity plus debt. So, we may also need to calculate what is the value of equity in the firm and what is the value of debt. So, the value of equity may be calculated by deducting interest from EBIT and dividing this amount by KE. So, EBIT, earning before interest and tax, we will subtract interest whatever interest we need to pay in the for using the debt. Okay, and whatever amount is left, we will divide it by cost of equity, so that we will get to know the value of equity in the capital structure. Similarly, we will calculate the value of debt by dividing interest by cost of debt, that is KD. This is something we have discussed in the topic of cost of capital. Okay. So, computation of overall cost of capital or capitalization rate, that is KO. So, when V is equal to EBIT upon KO, by interchanging the values, we may also calculate cost of capital or overall cost of capital. So, the overall cost of capital is equal to EBIT divided by V. So, in case the question is asking for V or valuation of the firm, we may calculate by using E plus D. We may calculate the value of E and D and substitute the values in the equation. We may also calculate value of firm by dividing EBIT by KO. And in case the question is asking for overall cost of capital, then overall cost of capital can be calculated by dividing EBIT by V, that is valuation of firm or value of firm. So, an optimal capital structure is one that gives the maximum value of firm with minimum overall cost of capital, that is KO. Now, let us try and understand this theory with the help of a practical example. Here is the example in front of you on the screen, and this is like this. The expected EBIT of the firm is rupees 2 lakh. It has issued equity share capital with KE at the rate of 10% and 6% debt of rupees 5 lakh. We need to find out the value of the firm and overall cost of capital, which is also known as WACC, okay, weighted average cost of capital. Now, let us see that how we may solve this equation or how we may answer this question. So, here is the solution. We can have these two columns, wherein in left column we may write the particulars and in right column we may have the amount. So, what is given in the question? EBIT, earning before interest and tax, is given in the question. So, EBIT here is 2 lakh rupees. So, very first thing that we need to deduct from EBIT is interest. Interest is 6% of 5 lakh, because 5 lakh rupees of debt is there in the company already, and this 5 lakh rupees of debt is raised at the rate of 6%. So, the interest is calculated by multiplying 5 lakh by 6%, that is 30,000 rupees. So, we will deduct interest from EBIT, that is 30,000 can be deducted from 2 lakh, and now we have net profit with us, and the net profit amount is 1,70,000. Cost of equity is also given, which is 10%. Moving ahead with the same problem and its solution, we will calculate value of equity. So, value of equity E, which is equal to net profit in equations. When I have shown you the equation, I have shown you that our earnings minus EBIT minus interest, when we divide it by KE, we will get the value of equity. So, here EBIT minus interest will give us net profit, and this net profit is divided by KE. So, 1,70,000 is divided by 10% or 0.10, we will get the value of equity, that is rupees 17 lakh. Value of debt is already given in the question, that is rupees 5 lakh, and our value of firm is equal to value of equity plus value of debt. So, 17 lakh plus 5 lakh will give us 22 lakh, which is our value of the firm. So, this is the answer of first part of the question. The second part says asks for WACC, that is overall cost of capital. For this, we have this equation wherein EBIT has to be divided by value of firm. Our EBIT, which is already given in the question, is rupees 2 lakh. It has to be divided by 22 lakh, which is overall value of the firm. So, 2 lakh divided by 22 lakh will give us 0.09, that is 9%. So, this is the answer of second part of our question, which asks for WACC. So, this is how we can calculate the value of the firm and WACC or overall cost of capital under net income approach. Okay. So, moving ahead, when we will see if the debt is increased by debt is rupees 7 lakh at 6% instead of 5 lakh. So, in previous part we have seen the debt was 5 lakh. So, only 5 lakh will be replaced by 7 lakh. So, the interest amount will be replaced by 42,000 instead of 30,000. Now, in this case the net profit will become 1,58,000. Cost of equity is same, that is 10%. Using this equation we will calculate value of equity, that is 15,80,000, and in this case value of debt is 7 lakh. So, the overall value of firm is 22,80,000, and using this we calculate overall cost of capital, which is 8.7%. So, in third case, when we have reduced the value of debt to 2 lakh instead of 5 lakh, now the interest will be 12,000 and the net profit is 1,88,000. Using these values, we will calculate value of equity, which is equal to 18,80,000. Value of debt is 2 lakh. Overall value of firm will be 20,80,000. And using these figures, we will calculate overall cost of capital, that is 9.6%. So, in conclusion, we can see this from the table, that whenever we are increasing the value of debt in the capital structure, the overall cost of capital is reducing, and at the same time the value of firm is increasing. While when we are reducing the proportion of debt in our capital structure, the overall cost of capital is increasing while the value of firm is reducing. So, this is about net income approach. In next session, we will discuss remaining 3 approaches of capital structure. Thank you for now.